Welcome to Jeff's World, the weekly 30-minute show where our goal is to help you make more informed investment decisions. We're going to cover key risks and opportunities for investors tied to developments around the world. And the best part, we take your live questions from the chat on YouTube. So you can ask us what's on your mind at any time by entering it in the chat. We'll get to those questions in a few minutes after we share some of our latest insights. Now, we've got a lot to cover, but first, we've got a few required disclosures before we get started. Of course, we don't know you personally, so we don't make personalized recommendations, but we do talk generally about the markets and sectors and areas of investing we think are likely to perform well or poorly and why, although we don't provide an outlook for specific stocks. And things can and do change, of course, so all the thoughts we share are subject to change as well. And investing has risks, and international investing has unique risks like currency moves. So please keep all that in mind. Now, as is the case every week, I'm joined by Michelle Ghibley and Heather O'Leary on the global strategy team at Charles Schwab. Good morning, ladies.
Good morning, Jeff. Good morning, everybody.
Good morning, everybody. Just as a reminder, again, I'll be watching the chat and the questions that come in closely, so please go ahead and make sure you submit them. Jeff, go ahead and kick us off with a quick rundown of what we're watching this week that could move the markets.
Yeah, a lot going on this week. So we've got today, of course, is a sober anniversary. Russia's full-scale invasion of Ukraine took place 3 years ago today. We've got signs of Europe further ramping up defense plans after European NATO members' defense spending hit 2% of GDP for the first time in 2024. It continues to look like it's moving higher there. The seven biggest European defense stocks have been acting like the new Mag 7, leading the markets with strong gains this year. I'll talk about that a little bit later. Now, it's always earnings season somewhere, and on Wednesday, we get NVIDIA's earnings, obviously a key pulse check on the global AI economy. On Thursday, the European Central Bank publishes their account of their January 30th policy meeting. We get the details, the minutes, what was discussed. Of course, they put out a statement after the meeting. They even have a press conference, but we get really a lot of the nitty-gritty details in that write-up. Of course, they cut rates by 25 basis points at that meeting. Now, that quiet period, that's a time when policymakers at central banks refrain from making public statements that could influence the market during the lead-up to a policy meeting. That starts now ahead of its March 6th meeting, where the interest rate futures market is pricing a 98% chance of another 25 basis point rate cut. So don't expect to hear much out of ECB officials, but we'll get those minutes, which will give us a good sense of where their heads were at. Now, on Friday, the January U.S. PCE price index, that's personal consumption expenditure price index. It's the Fed's favorite measure of inflation. They look at the CPI, but they were really focused on the PCE price index. And that is going to follow an upside surprise to the January CPI as the market and the Fed have become more concerned over stubborn inflation in the U.S. So that's a lot of what's going on. But of course, it's a new week. So it's probably new news on tariffs. There's been a lot new on tariffs. So let's talk about what all that means. So the latest from President Trump included a quote unquote reciprocal tariff policy on imports that includes value-added taxes, sales taxes of trading partners, and more specifically, tariffs of 25% on pharmaceuticals, semiconductors, and cars that could go into effect on April 2nd. Now, it remains unclear which categories of medicines and chips and autos might be subject to the tariff, but a lot of this seems to target Europe, particularly pharmaceuticals and cars, right? And of course, the big, semiconductor equipment maker ASML in the Netherlands. But I think the impact on the Eurozone would likely be relatively small, even if all of this were implemented, because exports to the U.S. of products in those three categories are just about 5% of overall Eurozone exports. So it's not huge. And, demand for pharmaceuticals and semiconductor equipment is pretty insensitive to price changes. So any additional tariff costs may get just passed on to U.S. customers. And also, many large European producers of drugs and cars already have significant production facilities in the U.S., so that reduces their exposure to potential new tariffs as well. So that was last week. Now, the next upcoming tariff deadline is the expiration date for the delay on Canada and Mexico tariffs to expire. That's on March 4th, but I think it gets extended. It might seem like the U.S. holds all the cards on negotiations with Canada and Mexico, given their economic dependence on exports to the U.S. But the exposure of companies is different. I've talked about this before on the show, but Mexico's largest exports to the U.S. are goods produced by U.S. companies operating in Mexico. They're not Mexican companies. It's GM, it's Ford exporting their products to the U.S. from their factories in Mexico. A lot of Mexican businesses just simply don't export to the U.S. In fact, about half of Mexican businesses don't. We're talking about the biggest stocks there: banks, Coca-Cola distributors, telecom providers, Mexico's Walmart. They don't have any exposure to tariffs because they serve Mexico. And that applies to Canada as well. Outside of energy exports, the largest Canadian exporters to the U.S. are automakers. It's Ford and GM again. It's also Stellantis and Toyota and Honda. These are not Canadian companies. They're not listed on Canadian exchanges, right? So that might help account for why the Canadian and Mexican stock markets continue to outperform the S&P 500 this year, even ahead of the expiration of these delayed tariffs. It also means that these big U.S. companies seem to be seeking to have a voice in the negotiations and want to keep Trump informed of the negative impact potentially of these tariffs. I know Walmart has talked about they're communicating to the administration about the cost, potentially inflationary consequences of these tariffs. Ford's CEO has talked about he's going to D.C. to talk about the Trump administration about the maybe potentially devastating, that was his word, impact it could have on U.S. businesses from higher steel and aluminum tariffs in addition to these tariffs on Mexico. So we'll see where that goes. Again, that deadline is March 4th. Again, I think it gets extended. Next is the 25% steel and aluminum tariffs. That's March 12th. They're due to go into place. Trump tariffs have a pattern of getting lowered, right? And the last time he did this in 2019, steel tariffs were 25%, but aluminum tariffs were only 10, and there's a reason for that. And I think, again, the 25% aluminum tariffs probably get reduced or eliminated or delayed prior to being implemented. Big reason. So we import about 8% of our steel. It's not that big of a deal. We import more than 50% of our aluminum. And most of the cost of aluminum is electricity. It's bauxite and electricity. It's mostly electricity. And the U.S. just doesn't have the electrical grid to make electricity in this country. We buy it mainly from Canada because of abundant hydroelectricity in Canada. Makes electricity cheap, and therefore it's less expensive to buy it there. We're just not likely in the short term to be able to really produce a lot more electricity to make a lot of aluminum here in this country. And as a result, a 25% tariff on aluminum would be very inflationary, at least in the short run. A lot of products use aluminum, from beverages to cars to airplanes. And those are some areas where U.S. companies compete on a global stage. So again, I think U.S. manufacturers are going to reach out to the White House, make their voices heard on how damaging to U.S. competitiveness a 25% tariff could be, at least in the near term. And markets seem to be betting that 25% aluminum tariff follows the typical pattern and gets delayed or reduced before it's implemented on the 12th. So that's kind of what we're looking at here on tariffs over the next few weeks. So it's certainly, I think, going to keep the markets jittery. We're seeing, another market. It's sort of flat in Europe today, but down a little bit in the U.S. as I look at my screen here, following Friday, which was one of the bigger down days, and Thursday was a little soft as well. So the market's getting a little bit more sensitive to this drumbeat of tariffs, even though I think the market's probably still worse than the bite. Michelle, Heather, what are your thoughts on the tariff situation here and how it's evolving?
Yeah, I'd say, other than those April 2nd 25% tariffs on auto, semis, and pharma, pending the April 1st review, the April 1st deadline for reciprocal tariffs is not necessarily an implementation date. It's a date for a report on the issue. It's kind of more of a plan for a plan. And the idea of how to measure these reciprocal tariffs and apply them is really very complicated, much more complicated than our current system of applying tariffs. And that's true for both the U.S. government and for importers to try to gauge and comply with it. So it's not clear to me that this can be sorted out in what's really a relatively short time frame. And
it's a super complicated issue, right, Michelle? Because you've got a schedule of tariffs for all the different countries. You've got different tariffs for most favored nations. You got different tariffs for nations with sanctions and others. And now you're talking about potentially bringing in non-tariff barriers like sales taxes to a tariff discussion on reciprocal tariffs. The US has plenty of non-tariff barriers. We've got quotas, we've got all kinds of things. We've got thousands and thousands of non-tariff barriers in the US. So if countries say, well, wait a second, if you're including some of the non-tariff barriers to trade outside the US, we've got to include the ones in the US. That means probably every single country has a different level of tariffs on every one of their products. So you're thinking 187 different countries with 10, 20, 30,000 different products in terms of trade. You've got now millions and millions of different individual tariffs being implemented by the Customs and Border Patrol. They had to delay the implementation of those de minimis tariffs on China, right? All those items coming in at below $800 in value because they just didn't have the staff or the technology to be able to figure all that out. Well, imagine now if you have literally millions of different tariffs for different products from different countries, trying to implement that at every single border crossing with every single product coming into the country. I mean, it seems like an almost impossible and insurmountable task. So it seems like things need to get simplified from here. But yeah, I think you're right. It's very complicated and probably a long road ahead. That April 1st deadline you pointed out is an important one. This is where we sort of begin to kind of feel what that might look like.
Yeah, it might be a reason to think it's part of a negotiation tool to get concessions.
Yeah, nailed it. Yeah. Again, I mean, we keep coming back to that, right? This seems to be more about statecraft than economic policy again and again. So, yeah, makes sense. And so again, I think that's why the markets are jittery around these things, but we're still up this year. And I think that's important. Again, the bark remains worse than the bite. We're very aware of the volatility and sort of the stress in the markets and the stress in companies around, what's going on here, but and the uncertainty around it. But nevertheless, again, there's a pattern to all of this, and we'll see if that continues to play out.
Yeah,
One of the interesting things. Oh, go ahead.
I just wanted to say one more thing, which was last week. On Thursday, U.S. Commerce Secretary Howard Lutnick told a delegation from Mexico that they should put their own duties on Chinese imports as part of an effort to avoid tariffs from the U.S. Again, it's just another demonstration of, using a tariff threat to maybe secure concessions.
Yeah, really important point. We know China's been exporting to the U.S. through other countries in Asia, but also through Mexico as well. A lot of Chinese products being shipped to Mexico, then shipped into the U.S. And Mexico has done something, over the last 6 months or so to try and crack down a little bit more on that. If they're not adding any value, then they're just acting as a conduit to avoid tariffs, and they don't want to do that. And so they have been cracking down a bit on some of that, and the U.S. has been more vocal around that. So you're right, statecraft here as opposed to economic policy per se. So interesting to see how all this is shaping up, and certainly countries are looking to see what they can do to try and shore up those issues so that we're not faced with these kind of tariffs. Yeah, so it's an interesting backdrop for the markets. I mean, we know how important trade is for revenues and for profits. Even for the S&P 500, 40 to 50% of revenues come from international trade. And in some sectors, particularly tech, it's even higher. So it's very important to these businesses in the operating environment that they're in, so that they can plan. And so we'll continue to focus on this. But again, don't panic around this stuff. There's a lot of emotion around all these things as well. And so, respectful of everybody's views on all of this stuff, and who knows where it's headed over the long term. And I'm certainly not providing a view on whether this is good or bad over the long term, but in the near term, there are certainly disruptions and economic costs and issues for businesses that we're tasked with trying to assess. So that's what we're trying to figure out here. And what's interesting in the midst of all of it, given the focal point of Europe here, particularly with some of these tariffs, the reciprocal tariffs, the auto and pharmaceutical and chip tariffs, Europe is kind of in the crosshairs of some of that stuff. Yet European stocks have been outperforming this year as we predicted they would, despite all those tariff threats. And in fact, Michelle, Heather, I've been talking a little bit about a new Magnificent Seven here. Now, I'm stretching that a little bit here, but look, we have seen not only European stocks rise really across all sectors, outperforming the U.S., but in particular in European defense stocks. The European defense and aerospace industry has been doing really well. So far this year, the 7 stocks, Mag 7 maybe, that make up the MSCI EMU, that's European Monetary Union, aerospace and defense index have gained over 15% so far this year. They pulled back a little bit in the last couple of days, but that really left the US's Magnificent Seven stocks in the dust. They're down 2% so far year to date. You can see this chart. I did it through Thursday, I think. You see they were up over 20%, and the US Mag 7 up only 1. Well, they've both pulled back a little bit. I think we're looking at maybe 16-17% gains for those defense stocks in Europe, whereas now the US Mag 7 are actually at a loss. Look, European defense stocks are up nearly 150% since the bull market began back in October of 22, more than doubling the return of the S&P 500 over that period. So been really interesting to see this. And since 2014, so 10 years now, the European NATO members have promised to spend at least 2% of their GDP on defense. They did not do that. They've only begun to do that in 2024. It's really been ramping up for obvious reasons. And it looks like it might ramp up even further this year. You've got the prospects of US President Trump working on a ceasefire agreement with Russian President Putin, excluding Europe, excluding Ukraine in those discussions, and at the same time reconsidering U.S. military presence in Europe, actually announcing this morning, I think, pulling out of Greece. So that further raises expectations for more European defense spending. You can see it in the chart here, how European defense spending as a share of GDP has really ramped up in the latest few years. And now that 2% target may become a floor, with maybe even higher spending. If they hit a 3% target going forward, that would translate to 800 billion euros by 2029, almost 4 times the level of the mid-2010s. So 800 billion a year by 2029 is just a massive amount of additional defense spending. Now, some of that may go to personnel, some of that may go to administration and buildings, but a lot of it may go to weaponry, and some of that coming from the US, but also some of that coming from Europe, and maybe potential financing coming from joint European debt issuance. This is the areas where European members are kind of in agreement upon doing this. So they might suspend or modify some of those EU deficit rules to try and hit this. So we'll see where that goes.
Now, Jeff, something to consider is that we did have a German election on Sunday. What might that mean for EU deficit rules and possible increases in expenditures?
Yeah, thanks, Heather. It's a really good point. So we just had that election on Sunday. And Michelle, I know you've got some thoughts on this too. So there's been a widening rift between growing public demand for more government spending and the self-imposed austerity mechanism in Germany known as the debt brake, which basically forces Germany to have a balanced budget. Germany is the largest economy in the EU, and so this fiscal austerity has kept a lid on overall debt growth in Europe, especially relative to the US. The US trajectory, the debt has just climbed and climbed and climbed. And in Europe, it has not. It's basically been flat. And that seems to have acted as a drag on at least relative growth in the region. It's sort of interesting to kind of see this. People talk about, really much faster growth in the US, but it's really debt-fueled growth in the US relative to Europe. Europe just hasn't seen that same type of thing. So following this election, that could change a little bit. Yeah, you can see it in this chart here. You've got this blue line with the Eurozone debt to GDP. It really hasn't grown in a very long time, right? Debt is not out of control. There are some countries, Italy, France, where it's much higher, but for the most part, it's remained in check. Their debt ceiling, if you will, has worked pretty effectively. In the US, not so much, right? Continues to climb. So that's one of the reasons why US economic growth has been much faster than Europe. It's been debt fueled. That could begin to change following this election on Sunday. So the Christian Democrats and Social Democrats are most likely to join forces in a grand coalition government after this election, with Merz as the chancellor. Those parties are in general agreement. Now, they're different parties, right? You've got Social Democrats and you've got the CDU, which leans to sort of center-right party. But one of the areas they do agree on is more spending. And how do they do that? So one way they could reform this debt brake, this balanced budget part of their constitution, by maybe allowing a bit more aggressive industrial and defense policy. And they could do it a few different ways. They could exclude defense spending from the budget. They could fund that at the EU level rather than individual country level. They could modify the rules around it to allow for infrastructure spending. There's some rules around saying you can't do transfer payments or cut taxes here, but maybe you could do some infrastructure over a long lifespan, and maybe that isn't subject to limits. So we'll have to see how they actually carry this out. There's a lot going on there, but it is interesting. And I know maybe, Michelle, you have some thoughts around maybe how they get around some of these rules and whether they're able to actually implement more spending.
Yeah, I think the idea of a two-party coalition is probably a good thing relative to the three-party coalition that really couldn't get a lot done the last time. So that's good, but like you say, that in order to reform the debt brake, they need a two-thirds majority. So they'll need help from other parties. And
Well, they need
might-
to. So, in
yeah.
order to drop the debt brake, like remove it from the Constitution, it requires a two-thirds majority. The question is like reform. What is reform versus, getting rid of it, and how much support would they need for that, and what are the changes that would go along with that, and what would pass the Supreme Court in Germany that would allow them? Right? They've tested some of these things before, and the court there said, the Constitutional Court said, no, you can't do that. And that put them back to square one. So it'd be interesting to see how they can try and come up with some wording around this that gives them some flexibility.
Yeah, they could declare an emergency and get around that two-thirds, just need a simple majority.
Right. Yeah. So obviously, the U.S. has been declaring emergencies around all kinds of things to justify its policies. Right. And so maybe that's a cue there for the right-leaning government in Germany. So we'll have to see. So yeah, Europe's been performing well and getting a boost today on those election results. Yeah, for two-party government as opposed to three-party government, where little could get done. Make a good point there. Another market that's been doing well lately, Michelle, is China. China's been performing well this year, really over the last year. What do you see is next for the world's second largest economy?
Yeah, last year we heard the idea that China is uninvestable. We heard that a lot, but despite that, China's stock market has been outperforming the S&P 500 over the past year. And it really just follows this pattern of volatility. You can see the blue line there for the Chinese stock market, pretty volatile. But it favors a long-term focus for investors. We've had a couple of really positive things that have improved sentiment lately. One is, this DeepSeek R1 news was really a wake-up call. China's been a place of an innovation, and Chinese innovation is often dismissed or underestimated. And there's also hopes of a friendlier stance toward business after President Xi met with prominent tech leaders last week, including Alibaba's Jack Ma. And then lastly, we've gotten a sentiment boost after there was a lack of those day one tariffs that we heard about on China by President Trump. So far, just 10% additional tariffs. That's well short of the 60% threatened on the campaign trail. In terms of upcoming things to watch, March 5th is the National People's Congress. If we get a sizable and concrete fiscal stimulus, that could help fuel further stock gains and bolster both consumer and business confidence. But underwhelming stimulus could prompt, a further pullback. And then, we could also get new tariffs on China from Trump. Those are a risk, but it appears that, both countries are seeking a deal, Jeff.
Yeah, there seems to be some back channel going on there on those tariffs. Michelle, what do you make of some news I saw this weekend about, government-backed property developers buying up land at a premium from local governments here, trying to maybe put a floor on the property markets and really address one of the weaker or drivers of weakness in China's economy?
Yeah, the Chinese property market contributed about 30% of GDP before the slowdown started. It was really a government-initiated slowdown in late 2020. I think that it's a good thing. We're getting a little bit smaller declines in prices. As you mentioned, a little bit more of a premium for some of these property sales. And it indicates maybe, again, a little bit increase in sentiment. I think a bottom in the property market there is going to be a really long, slow thing. But, anything that's less worse is a good thing.
Yeah. I think the last few months have been 0.2% decline in the average house price, as opposed to like a 2% monthly decline, right? So, low, just sort of flattening out here, kind of a long U. But yeah, that can turn around sentiment, right? If people don't think prices are plunging anymore and maybe showing some signs of stability, you can maybe see some of that optimism come back. Obviously, the stock market's been moving ahead of that. So, interesting to see what's shaping up there. March 5th, as you point out, a key date to watch. All right, Heather, let's move over to the chat Q&A. What are the questions that are coming in?
Well, first, I'd like to remind our audience that we do have a survey out today. So please go ahead, click on the link and provide feedback so we can better approve your experience. We talked a lot about the China. What about India? So we've seen some market volatility there. Do you have any comments on that economy?
Yeah, Michelle, do you want to take that?
Yeah, I would say that, there was a lot of optimism about India last year, fully reflected in the stocks, well above their long-term average PE, 22 times. Indian stocks tend to get, as a whole, the market gets a premium, but last year was really kind of outsized. And since then, we've had a little bit of slowdown in the Indian economy. Inflation is still biting. And, we had Brazil starting rate cuts last year, but India really was lagging behind because inflation was so high. But now they've started cutting rates, and maybe that can help put a bottom in the economic growth.
Yeah, India, much more of a service-based economy than manufacturing. We often think of emerging market economies as making cheap goods to sell around the world. India's a little different. Generally more of a service-based economy, getting more into manufacturing, but much more on the services side. And because it's more on the services side, it's less economically sensitive, and that kind of gives its companies a bit more of a premium because you don't get those big swings up and down. The problem, as you point out, the stocks tend to be very expensive, kind of the opposite of China. That's why we've kind of talked about emerging market exposures being favorable to portfolios over the course of the last year, because you've got India where everything was going right, but the stocks were expensive, and China where everything was going wrong, but the stocks were very cheap. And there was always the potential for those to provide some diversification. And if things change at all, they maybe offset each other. And that's a little bit of exactly what we've seen here. So nice to, as opposed to picking individual countries in emerging markets, always a risky endeavor. Having some emerging market exposure as a small portion of your portfolio helps you get some of that outperformance. I mean, they're doing well. So I'm just looking at my screen. Emerging markets are up 6% so far this year. That's 3 times the return of the S&P 500. Comes with some volatility, but interestingly, those components, India and China, two of the biggest components of the EM index, have been offsetting each other a little bit here in terms of their volatility and direction. So interesting to have that benefited to a portfolio. Thanks, Heather.
Yeah, one other thing I'd note, and we've talked about this here on this show, is that India could be a trade war beneficiary. They have some of the highest tariffs in the world, and they could start cutting tariffs. In fact, they already have so far this month. And if they cut their tariffs by 1%, it could boost their GDP by 0.5%.
Yeah, that's right. So the traditionally very high tariffs, protective of their domestic industries and agriculture and the like, but they could drop them. We've already seen them start to do some of that. So interesting to see. Heather, what else do we have?
Well, we do have, it's sort of a comment / question. Peter Schiff has thrown around the dreaded stagflation number. Canada has certainly announced that recession could be a probability due to tariffs. What is the actual concern, though, about debt-fueled growth? Are we going to see a resurgence in inflation?
This is probably the biggest concern I have over the long term is the unsustainable growth of debt for many of the world's major economies. It's not just the U.S. And eventually, issuing more and more debt just borrows growth from the future. I mean, you're just borrowing tomorrow's spending and spending it today. And eventually that can catch up with you. We've seen countries, economies over time eventually get ahead of themselves. But where is that threshold? I don't know. Japan has 3 times the amount of debt relative to its GDP than the US does. And sure, Japanese economic growth has been weak over the last a few decades, but it hasn't been so much the result of debt. It's really been the result of demographics. The debt situation really hasn't pushed up their interest rates, hasn't pushed up their inflation, right? Japan really didn't have any inflation. So we don't necessarily get this one-to-one relationship with tremendous amount of debt growth corresponding with weak economic growth and high inflation. Generally, that's not what we've seen. We've seen different cases in different countries. We've seen Zimbabwe, where yes, interest rates soared, the currency plunged, and the economy was plunged into a deep downturn. Japan, very different experience. And so I think it depends on the country. It depends on its credibility of its central bank. Depends on what the assets are that are backing that debt growth. Generally the market views that buying U.S. debt, U.S. Potential growth and productivity growth is quite strong and supportive of that debt growth. And the market continues to favor putting its assets in U.S. Dollar-based debt. Could that change if U.S. trade changes dramatically? If we stop spending so many dollars around the world, will there be less interest in buying U.S. debt? And would that push up interest rates? That's always a risk. And we'll have to keep an eye out for that. Certainly tariffs threaten that. But so far we haven't seen it. And again, I think the tariff bark is probably worse than the bite. So far, no, I don't think we're in an environment of stagflation. Global economic growth this year is around 3.1, 3.2%. That's the average we've seen for the last 30 or 40 years. So growth is okay. Inflation's a little higher than we'd like it in the US, but in Europe, Canada, Japan, most Australia, it's around 2%, right in line with central bank targets. So that's why we're a little bit more favorable of markets outside the US this year than inside the US. Just the economic, the fiscal and inflation backdrop is just more favorable.
Thanks so much, Jeff. It does look like we're close to out of time. Again, I'd like to remind our audiences that we do have a survey, so please go ahead and provide your feedback. Tell us what you'd like us to talk about. And go ahead, Jeff.
Absolutely. Yeah, we want to make this as valuable to you as we can. So let us know if what we're doing is helpful and what else we can do to help you out. But I'll always appreciate the questions. It makes the show better. It's my favorite part of the show. And I love hanging out with Heather and Michelle and just kind of having an open investment policy meeting with you all and talking about the markets. So appreciate that. Hope you like the transparency there. Thanks to our producers as well, Andrew and Gabe, and everyone for those questions once again and joining us. You can tune in each week at 11 a.m. Eastern or catch a replay on YouTube. Be sure to click like on the show and share your comments on what you're watching in the markets, and we'll see you again next week.